because most people only adopt about 5 or 10% of the software that they had access to. So
hello, everybody. This is Jake Senziano, host of Wheelbarrow Props Podcast, the #1 multifamily podcast on iTunes, here with my co-host, the multifamily mentor, the coach, the chef, the father of 6, the best-selling author, the G-Daddy, Gino Barbo. Gino, how's it going?
Mr. Stenziano, I'm doing good. Had a busy weekend, huh, Jake? A little money mixer action. We got a little home run derby I heard last night. What else is going on this weekend?
Yeah, we were hanging with Mr. Jim Clayton. He was doing some renditions of country roads at our event. Always making it happen, big man. So we have a special guest today. Today's guest is Josh Cantwell. Josh has been a full-time investor since 2003 and has bought and sold over 750 properties. He's now involved on the debt side of things and has recently, he's gone to the dark side, Gino. He's jumped into the apartment game. So without further ado, Josh, welcome to the show.
hey guys, Jake, Gino, thanks so much for having me on, man. Really a pleasure, and I'm so excited to share some of this stuff with your audience.
Hey, we want the timeline now. Give us an overview, how you got into real estate, and then how that evolved into being involved in lending and now some apartments. So give us a quick overview.
Sure. Yeah. So the journey starts in 2001, believe it or not. I was a financial advisor a couple years out of college, and I realized that most of my really wealthy clients did not have all their money with me as their financial advisor. They had money in real estate. They own rentals, they own buildings, they own restaurants. They didn't own the actual restaurant, but like Gino did, but they actually owned the restaurant, they own the building, and they own apartments and all this stuff. And I took notice. I was 24 years old, and I'm like, what are these guys doing that's different? And I bought my first investment property shortly thereafter and realized that was a way to make passive income. Like most people, I started in residential. I started wholesaling properties. Cleveland at that time was already in the middle of a renaissance in a very bad way. We were already in the middle of a foreclosure crisis. There were dozens about a dozen actually Fortune 500 companies that left town. So the foreclosure crisis hit us about 4 years before everybody else. We were already in a foreclosure crisis in 2003, 2004. So I started focusing on investing in debt and short sales and wholesaling properties because I didn't have a lot of extra cash. I always had the dream of investing for cash flow like you guys do, investing for passive income, but I just didn't know where to start or how to do it. So I focused on short sales, which is what my market told me was an investing opportunity. And we did hundreds of those all the way from 2003, 2004, all the way to 2010. 2011, I got sick. I was diagnosed with advanced pancreatic cancer. For those people that are aware of the disease, for most people, it's a death sentence. It has just an 8% survival rate. And I quickly realized that I had totally screwed up my investing strategy because everything I was doing was really based off of my ability to get up, get busy, wholesale properties, negotiate short sales, and make an income from wholesaling. And, I had to take 9 months off of work before my surgery and after my surgery. And during that time, I didn't make any money. I couldn't make money. And I realized I'd made a massive, massive mistake. One thing I did right though, guys, was right before my surgery, I bought a couple single family flips, a couple single family rehabs. And I raised a couple $100,000 of private money to fund those deals. And I bought the properties. I turned over all the work to the contractors. I turned over all the work to my team. And they fixed those properties and flipped them while I was in the hospital. And so my surgery was in November 2011. And in April 2012, I collected $80,000 in profit checks from these 2 flips. And I realized then, it dawned on me, and I thought, hey, what if I could just control properties? What if I can control contractors? What if I can control assets by controlling the money, by controlling the funding? Like, that was fun, right? I was in the hospital, which wasn't fun, which, going through that wicked surgery wasn't a good time. But coming back out of the hospital and realizing that, wow, I could control a deal. I could make a lot of money by really controlling the funding. And that's really where this all started. And then since then, we've done hundreds and hundreds of rehab flips, hundreds of private lender loans. We now own a stake in 1,700 units of apartments, all because I fell in love with private money, which was all really due to the fact that I was diagnosed with cancer. So crazy story, but that's how it goes.
So how did you systematize yourself? I mean, from being in the hospital and doing a couple of deals, how have you been able to build systems and implement them to actually grow the company? Because 700 transactions is a lot of transactions. That's a business. That's not a hobby, and that's not just a transaction base. You're actually creating a business. How have you done that?
Yeah, great question. So we adopted two things. We adopted hiring the best talent we possibly could at a very young age. When I was a financial advisor, coming out of college, I got my Series 6, my life and health license when I was still 21 years old. I was a senior in college. I hired my very first employee. Her name was Liz Ensley. I still remember her name, our first ever employee when I was 21 years old. And I bought into at that time, I bought into, only do what only you can do. So I knew when I was a financial planner, like meeting with clients, if I wasn't in front of a client or fighting to get in front of a client, I was unemployed. And so I gave Liz everything else other than sitting in front of clients or fighting to get in front of clients, dialing for dollars on the phone, prospecting, or being in front of clients. And so that translated into my real estate business when I got started with that. I realized that, you're either making money in real estate when you're acquiring properties or raising capital. You're acquiring properties and raising money. That's the two things that make this business go. And everything else I had to outsource, delegate. And so in 2004, when we really got going with our residential business, we very quickly actually adopted software. I actually developed a software from scratch called RealFlow with my old partner, Greg Clement. We started that software. We wrote millions and millions of lines of code. We hired a software engineer, and we built our business into software in 2006, way before it was popular. Now you see software of all kinds for real estate. Back then it was like, oh my God, there's software for real estate. So we adopted that process. We adopted taking SOPs and putting them into software and then having our team work the software, work the system. So that's really where it came from. And we realize now to build a big business, it comes down to regular recurring procedures, regular recurring process that anybody can follow, any team member can follow, and then having an amazing team follow those systems. So software is a huge piece of it. You got to have great software, and software is only as good as what you adopt, right? So you've got to constantly train on your software that you use, whatever it is, and make sure your team is very, very affluent with it, knows how to use it, because most people only adopt about 5 or 10% of the software that they have access to. Mm-hmm. So we try to get them to adopt a significant amount of the software and make things easy. And we're constantly adding, I could even say replacing staff that might be a C player, a B player that we can upgrade to an A player. It's a big, big part of my job is making sure we have an elite staff.
I like that. I know Jake is drooling right there.
Sounds like he's top grading, Gino.
Oh yeah, top grading is one of my favorite books, man. One of my favorites.
How did you when you got into multifamily? How did you learn to underwrite deals, and what were you looking for in deals that made sense to acquire?
Yeah, honestly, Gino, I kind of stumbled into it. I've been running my private equity fund for the last couple of years. In 2015, we had more private money than we wanted to deploy into residential deals. So we started a private equity fund. We started being a hard money lender, a private money lender. And then our investors started coming to us and they started saying, hey, look, we love the returns we're getting in your fund, Josh, but what else do you have? What else do you got? I've got 250,000 with you. I've got $500,000 with you. I got 50,000 with you, whatever it is. What else do you have? And one of my investors, his name is Larry. Larry came to me and said, Josh, I've got $600,000 in your fund and I want to liquidate it all. And I was like, oh shit. Oh no, I don't want him to take the $600,000 somewhere else. And I said, well, help me understand, Larry, what are you going to do with the money? He's like, well, I own a bunch of apartments and I'm going to take the $600,000 that's in your fund. I got to structure an exit. I'm going to sell out of my apartments. I'm going to owner finance under my son. But I'm really just a passionate for apartments. And I was like, well, there's something there. So I started talking to a lot of my other friends that had success with apartments. And And they started telling me about like different ways to syndicate, different ways to buy apartments, different way to buy value add apartments, buy them at wholesale prices. And I really enjoyed learning more about being a rehabber, being a residential value add investor. I enjoyed looking at apartments that were significantly distressed. And we were able to locate some operators who happened to be friends of mine that were buying apartments. And they said, hey man, like we've got this massive apartment deal. So the first apartment deal I ever got involved in was a $10 million purchase with $10 million of rehab, 750 units. And we went to our investor group and we said, hey, we're gonna jump in and we're gonna be an equity owner in this apartment deal. And we want to know, like, hey, you know, you're invested in our fund. Is this of interest to you? Do you have any interest in apartments? And Larry, this investor that was about to leave us, said, yeah, absolutely. I love this deal. Because based on all the pro formas and based on about a 7 cap, the building pencils out, we're going to be all in for 24 million. It's going to be worth $40 million. And that'll, you know, once it's all leased up at the end of this year, cash out refi, we're going to cash out about $7 million. We'll put a new $30 million loan on it and we'll have $10 million of equity. So that experience was almost by accident because I had this investor, Larry, that scared me by liquidating a significant amount of money. And so I just started searching. You know, if you're an entrepreneur, you're a real estate investor, you've got to be resourceful. And when you find a negative experience, which, you know, that $600,000 represented, you know, a chunk of money that we were going to lose our management fees on, we were going to lose our capital in our fund. I was like, well, what's on his mind? Why would he focus on apartments? So that's how I kind of stumbled into it. Now, since then, we've become a minority owner. I'm not the operator like you guys. I'm not the guys that are doing the boots on the ground. I'm not the guy that's, finding the deals and structuring them all and signing the personal guarantee. But we do and are invested in 1,700 units. We own a stake in all of those, and we're primarily focused on value add stuff that needs some lift.
So is it all in your local market in Cleveland, or do you go outside your market?
We're mostly outside of our market. We've got a 216 unit in Crosby, Oklahoma. Lawton, Oklahoma. The building is called the Crosby Building. So we have 216 units there. We've got 750 units in Georgia Plains, Georgia. We've got another 400 units in Albany, Georgia. We've got another 200 units outside of Atlanta, and we've got 164 units in Cleveland. So we're in 3 markets right now.
So when you look at a market or you look at a deal, what are you specifically looking for? I know there's a value add component, but what is your criteria as far as, do you have any specific cap rates or cash on cash returns, or are you refining these deals? Are you a long-term holder? Are you going to sell? What are you guys looking to do?
Yeah. I appreciate you asking. And yeah, we have some specific criteria. So we're definitely looking for A-class and B-class apartments. We're definitely looking for things that have at least a 10 cap, stabilized 10 cap. We're looking for things that are value add. So either bad management or the properties have not been updated for a long time. There's opportunity to do a value add improvement and then increase the rents. And we're always looking. One criteria we have is we're looking to invest our capital and with our investor group that also invests with us. We're looking for deals we can get in. There's enough of a value add and there's enough of a lift in the value that it can be refinanced within 18 to 36 months, put permanent debt on it, and cash out and pay back basically the bridge loan, the acquisition loan, and pay back all the equity investors within 3 years or less. And then those equity investors stay in the deal and we stay in the deal in perpetuity, even though we have no more money in the deal anymore.
That's awesome.
So, and we're looking
going old school, Gino. They're going they're real heavy lifts, right?
Yeah.
Well, yeah. I mean, like, I'll give you an idea. The last deal, the deal we're doing. So we've got a big wide range, right? So, Jake, we've got the one deal that's 10 million purchase, 10 million rehab, right? So with a $40 million stabilized value, might even come in at a 6 cap with a $45 million stabilized value. So we got that's the biggest lift we're doing. And we have a great operator. We've got 150, 200 guys on the ground every day renovating that building. So that's at one extreme. The other deal that we just did was a $9.2 million purchase, and it's already valued at the closing at 11.5 million. It was appraised at 11.5 million. We're buying it for 9.2. We only penciled out $2,500 per unit. So we only penciled out $410,000 of very cosmetic rehab. But that property never hit the market. It was off market. It never hit, LoopNet.
Are you starting with the agency debt on that one, or are you going in with bridge financing on that one?
Yeah, great question. We could have done either one, Jake. We could have gone in with just agency debt from the beginning, but the goal was structure it where we can get the investors, the equity investors out of it. So we went in with a bridge loan. It's a 18-month bridge loan with a 6-month extension option. Based on the appraisal that already came in, our first mortgage lender is already like, hey, I know for sure we can refinance you guys out, no problem. But based on doing doing some of the value add improvements and some of the rehab, and then turning over some of the units are already underpriced significantly. It's been the same owner of the building for over 20 years. He's a great operator, the former owner, but he hasn't done any significant improvements to the unit. So we're going to drop $2,500 into each unit. We're in the process of doing that now, increase the rents. It'll put the value of the building at about $14.5 million. And then we'll refinance it into agency debt in about 2 years.
So you just want to refi quick so you can pull the cash out and not have a onerous prepayment. That's why you're going with the bridge on the front end, right?
That's right. That's right. And we want to get the investors out. We want to do exactly what you just described. And we also, on the refi, we're doing refis at about 70 to 75% loan to value based on the new stabilized value. So we're not pulling all the cash out. Long-term agency debt's not going to allow you to go more than 75% long-term, right?
Mm-hmm.
So we're penciling out 70, 75%, depending on what type of asset it is, and trying to get everybody out of it. So, because what I found with investors is there's a certain type of investor that wants to get in and out in 6 months to a year. And a lot of those guys, they have to do smaller residential deals to get out in 6 months or a year. Then you've got guys that are comfortable being in apartments long-term, syndication, being for 5, 7, 10 years. The group of investors that I work with, there's about 200, 225 of them. They like that middle ground. They like to know that they can be in a deal for maybe 18 months to 36 months. They just like the idea of getting their capital back and being able to touch their capital again and then doing another deal, doing another deal. So the goal is over the next 10 years, to maybe do 3 to 5 deals with them. And we're, in the middle of that now.
So you're refining them out and then you're leaving them in the deal. And is that, I'm guessing there's a split after the refi in terms of, and what's the split, just out of curiosity?
Yeah, typically, great question, Jake. What we're typically trying to arrange is a situation where during the stabilization phase, between purchase and the refi, we're typically paying them a 10% preferred return, and they get a quarterly check. And then upon stabilization and refi, there's cash out refi proceeds. And then if you add their 10% pref return and then their cash out refi proceeds, we want that to equal about a 17% internal rate of return. So if their refi happens at 24 months and they get some cash out refi proceeds and their 10% pref they've gotten for the first 24 months, the goal is to have that targeted at about 17 to 18% IRR. Then they get their money back, they got their principal back, and then anything over and above that is basically gravy. They're basically playing with the house's money, right? So at that point, they're going to own somewhere, on average, it's every $100,000 investment has been somewhere between 0.4% equity ownership in perpetuity to up to 1.5%. It just depended on the deal. How big was the deal? How small was the deal, et cetera. So just call it on average, let's say 1% equity ownership in perpetuity. So you have a $10 million building. Let's just call it round numbers. Let's say 80%, $8 million bridge loan. We need to raise $2 million. If we raise $2 million, we're going to do, let's say, 20 units at $100,000 a piece. And we might be giving up somewhere between 10 to 20, 22, 25% equity to those investors. And they're bringing in all the cash, all the down payment, all the soft costs, zero money out of our pocket. Or if we're working with an operator, often, zero out of their pocket as well.
It's an interesting strategy. I like it.
So Josh, I get the question all the time from students. Where do you find deals? Where in multifamily do you find deals? Where are you finding these off-market deals?
Yeah, it's a great question. I mean, most of the stuff that we've found is through brokers. It's all off-market stuff through brokers. It's all pre-listings that brokers. It's relationships with them. Part of it comes from the fact that we've been able to, posture up and tell the brokers, look, we've got the capital. It's in our account. Like we manage $30 million. It's in our fund. It's available to us. Some of the operators that we work with, they're finding the deals, and they've, some of those guys have a track record like you guys do. They own 1,000 units. They own 1,500 units. They're able to posture up with brokers and say, look, we're going to make an offer. We're going to give you an LOI. We're going to make an offer. But if you accept it, we will close. And here's our track record of closing. We've closed on this 735 unit. We've closed on this 407 unit. We've closed on this 216 unit, this 164 unit. And so a lot of it's come from that. It's relationships. It's working with with brokers a lot. The latest deal that we just closed came through a mortgage lender. Mortgage lender was approached by an off-market owner who had owned this building in Cleveland for, over 25 years. He self-managed it, and he did not want his employees and he did not want his tenants to know that the building was for sale. So he went to a local lender, a Marcus and Millichap office, and said, hey, I've got this building. I want to sell it. Do you guys have any buyers who, you guys already know can get approved, that you guys can finance? And my friend Jack Petrick had bought several smaller buildings, a 25 unit, a 35 unit, a 40 unit, and had closed a couple of deals that were kind of those tough to close type of deals. And they said, hey, I know Jack and Josh, they have the cash, they have the experience. If they make you an offer, they can close. And so the deal never hit the market. It never even had another offer on it. It never had anybody else ever see it. So, I hate to say it's kind of a boring strategy, but man, it's all about relationships. Real estate's a people business. I say all the time to my audience, look, the business of business is people. It's all about the people. It's all about the relationships. And so, getting an off-market deal through direct mail or through, other routes, sure, those happen all the time. But the bigger deals, those typically happen by somebody who's a center of influence that has control over that project.
I like that. Why are you smiling, Mr. Stenzi? I know I see you smiling there.
Just always smiling, man. Always just happy, buddy.
Yeah.
Josh, let's get into your 5-step process for raising capital, because I think it's important. And we have a lot of students who are intimidated by raising capital. And I always tell them, just don't think about raising capital, think about offering an opportunity. So I'm curious to find out how you approach it.
Yeah. Well, first thing is, let's talk about mindset even before I get into the 5-step process. I appreciate you asking this. This is my favorite thing to talk about. So I could go on and on. I'll keep it short. The first thing is mindset. And I'll tell you guys a story, and I think this will resonate with your audience. When I was a financial advisor, I took an appointment about an hour away from my office out in Madison, Ohio, which was, way outside of Cleveland, way out in the sticks, right? So I was a financial advisor. I had inherited this client, inherited this account, called on them. I went to see them. I pulled up, and it was like, oh my God, it was this old, white, dirty farmhouse, like gravel driveway, old barn in the back that looked like it was falling over. I pulled up in my expensive sports car and my expensive suit. And I was like, oh my God, like, what am I doing here? Right. And I'm embarrassed about this story because I totally judged a book by its cover. Well, I went in, I sat down at their kitchen table, which I literally thought the chair underneath me was going to snap and break in half when I sat down. The kitchen sink was filled with dirty pots and pans. And the whole house was dusty and dogs running around. And I sat down with them, and, I was like, God, how fast can I get out of this appointment? And sure enough, like, I started talking with them, and here he had worked at General Motors for 35 years. He built up a massive pension, Social Security. He had variable annuities. She was a teacher for 35 years. She had a massive pension. They owned all kinds of land. They owned oil and gas leases, and they were millionaires, even multimillionaires, probably worth $1.5 million. They were comfortably retired. And I was like, oh my God, here I am, young punk, driving a sports car, and I'm just getting my career going. And I would love to be in their shoes, you know? I had totally made that mistake. And so when I think about capital, I think about that appointment. And everybody that I know, doesn't matter, you know, what kind of Rolex they wear, what kind of car they drive, or what kind of car they don't drive, what kind of house they live in. Everybody has the same goal. Everybody has the same goal of taking care of their family, retiring early, just enjoying their life and making smart financial decisions. And so what really with raising capital, what it starts with is if you believe in what you're doing so much that you think it can benefit other people, I tell my audience, look, you have a moral obligation to tell them about it. You have a moral obligation to present them that opportunity, Gino, like you just said. Because if you withhold that opportunity, you may be holding back something that could help somebody else retire, or something that could help them stabilize their business or stabilize their income that they couldn't get from somewhere else. So it comes with mindset. And if you start with mindset and thinking like, I have a great apartment deal, this is going to help other people with their financial goals if they're a passive investor in my deal, it changes everything from I'm begging for money to I have an awesome opportunity that I can help other people with. So it really starts with the mindset. Then to get into the 5-step process, step number 1 is you've got to create what I call an irresistible, devastatingly simple offer. It's got to be something that your average person can understand. I deal with very affluent people. I also deal with total newbie investors all the time. And we want to keep our offer, whatever it is, to be so simple that we can explain it in 1 minute or less. I did an event, one of my own training events years ago, and Kevin O'Leary came from Shark Tank. And he said to me, we were talking in the green room in the back, and Kevin said to me, and then he said it on stage too, he said, Josh, listen, we did a study of everybody who got funded on Shark Tank. And every single person, 100% of them, that got funded on Shark Tank, one of the criteria was that they were able to articulate their investment opportunity in 1 minute or less. So you've got to have an irresistible, devastatingly offer that you can explain in 1 minute or less. You can't say, well, I'm going to buy this apartment building, we're going to stabilize it, and then we're going to lease it up, and then hopefully we're going to refinance it. It's going to take, blah, 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 and going on for 5 or 10 minutes. It's got to be something like, hey, when I meet with people and we talk about like new relationships, I say, look, they ask me what I do. And I say, I don't say I'm a real estate investor. I don't say I'm an apartment investor. I don't say I run a private equity fund. I say, I raise capital for real estate. We buy foreclosures and distressed properties and apartment buildings, and we pay our investors a fixed double-digit rate of return.
Done.
Right?
Mm-hmm.
So it took me 15 seconds to say that, right? So whatever your offer is, whether it's a syndication, whether it's your own apartment, whether it's a value-add apartment, whether it's a fix and flip rental property, you've got to be able to articulate that in, when I did a lot more single-family flips, I would tell investors, look, we raise capital from investors. We buy foreclosures and distressed properties. We reposition them, and we pay our investors 12% interest or 15% of our profits, whichever is greater. Right? Devastating and simple. Mm-hmm. That's step number 1. Got to craft the offer. Step number 2 is I teach my investors. This is something I learned as a financial advisor. I write down, I call it my Project 100. Step number 2 is to write your Project 100 of identifying who is your ideal avatar that you want to raise money from. Okay? And you could say, well, I want to raise money from everybody. And I used to take that approach. I used to raise money from everybody. Now I have a specific types of avatars, specific types of people that I want to recruit and raise money from. I'll tell you another story. My friend Jake is a commercial insurance broker. He's very successful. And Jake had a lot of trouble getting his commercial insurance agency off the ground because he was a generalist. When he became a specialist and he only started selling commercial insurance to nursing homes, memory care facilities, assisted living facilities. He became known as the guy that did commercial insurance for the adult aging community and for those types of operators. Now he's got clients out the wazoo because they all say, well, hey, if you need insurance and you own a memory care facility, or you need insurance and you need, assisted living, you got to go talk to Jake. His name is Jake Pease. So you got to go talk to Jake. So when you're looking at apartments, or you're looking at your opportunities, there's a lot of different ways to invest in apartments. You're going to do value add. You're going to do syndication. You're going to do refinance. You're going to go in with agency debt at the beginning. What are you going to do there? Are you going to invest with your own money? You're going to invest with partners. I would say don't be a generalist, because if you have a specific thing that you offer, then you can go talk to a specific avatar that you want to raise money from. So one of my avatars, give you an example, guys, is I raise money from guys that own e-com businesses. Guys that own e-com companies, Amazon businesses, because some of these guys are very young. Some of them are older, but a lot of times they're very young, right? Amazon and selling on Amazon is relatively new. These guys have a ton of net free cash flow. They're making $200,000, $500,000, $1 million or more of net free cash flow per year, and they're selling their e-com businesses for windfalls. And what do they want to do with that money? They want passive income from it. So that's one of my avatars. So identify who is your ideal investor. Who is your avatar that you want to talk to?
You should probably be going after the crypto guys, and you should probably be going after the digital marketers, all these people that are making $20,000, $30,000, $50,000 a month, and they know it's a job and they're churning every month and they like it. But then after about 3 or 4 years, it gets tired and their tax burden is like, wow, I'm getting hammered with taxes. So that's definitely another avatar that I probably see you focusing on also.
Yeah, absolutely. Like, give you an example. My friend Ryan Moran is the owner of capitalism.com.
Yep.
Imagine owning that website, right? So I was actually at the Home Run Derby with him last night. Last night, the Home Run Derby was in Cleveland, and we were there watching an amazing Home Run Derby, and Ryan and I are talking about capitalism.com. But I go speak at Ryan's events. If I can be at Ryan's events, I go, because Ryan's audience, hundreds, thousands of people that pay attention to him. He has events, 800 people there. They're all e-com business owners. They're my avatar for investing in my fund or investing in apartments with us. So that's one of 3 different avatars that I go after. Step number 3 then is, where can that avatar be found? So I just gave the example of going to Ryan's event and specifically networking with those people, because I have influence there now, because I have a lot of e-com business owners who are investors with me. I can talk their language about Amazon. I can talk their language about their websites and physical products and shipping and margins, and talk about how, hey, when you have net free cash flow or you have a windfall, you should take some of those off the table and invest passively in real estate. And oh, by the way, that guy and that guy and that guy and that guy who's at this event is already an investor with me. So I'm driving that relationship really deep. So instead of just being very vague and kind of being a generalist, I focus on that step 3, which is, where can that avatar be found, right? So you got to be strategic about where you're going to go. Maybe start with your chamber of commerce. Maybe start with BNI networking meetings. Maybe you go to multifamily boot camps and events. You go to your local landlords or your home builders association. All these different kind of places you can start with. But everybody wants to invest in real estate. I mean, my friends who are in software, my friends who are insurance salespeople, they're all thinking about, like, how do I get passive income? And obviously real estate's the best way, right? Step number 4 then is, once you're out meeting these people and you're collecting business cards and you're getting phone numbers and you're getting cell phone numbers, and what I do when I'm at an event is, when I meet with somebody, maybe having a drink or we're talking, and I tell them I run a private equity fund, and I talk very high level. I ask them tons of questions about them. And then at the end of the conversation, when it's winding down, I'm talking to somebody else, I say, hey, let me give you my cell phone number so we can stay in touch. I don't ask for the business card. I say, let me give you my cell phone number so we can stay in touch. So I give it to them and I say, hey, why don't you call me right now or text me right now? So we might be at a bar. We might be at a country club. We might be at an event. We might be at one of your guys' events, whatever. Hey, here's my cell phone. They call me back. I save their number. Now I've got them right in my cell phone forever, right? So, and by giving my cell phone, they almost always feel obligated to give me theirs. And now I've got that. It's very easy, very simple way. Even, if you don't carry business cards, you don't have one, offer your cell phone. And then, of course, people will reciprocate. I did that last night. I was at the Home Run Derby. This guy, John, that I was hanging out with Brian, is very successful. He does very expensive gifts. So, a lot of people buy swag for their best clients, right? Or their friends or family, they buy swag. Well, this guy's swag, his average gift is worth $1,000. Right? He's got 26 of the major league teams are his clients. Major League Baseball teams are his clients. So the owners, the high net worths, they buy gifts and then they ship them to their best clients. Well, I was talking to John all night. At the end of the night, we're walking out of the ballpark, literally last night at midnight. And I'm like, hey, John, would love to stay in touch. Here's my cell phone number. And why don't you just give me a call, and I'll have your number, and we'll stay in touch. So had a great conversation about his business, my business, and we'll grow that. So again, once you have these contacts, you've got to have a multi-medium marketing approach to stay in front of them, right? So we do everything from podcasting to email marketing to quarterly newsletters that we send out, phone calls, text messages. We've got a back office, much like you guys do, a back office where people can register and log in and see our offers and see our opportunities. We have a couple of our teammates on our team that stay in touch with people, sort of a multimedia marketing approach. Now, when that got started, right, if you're new to apartment investing and, Jake and Gino are your mentors and you're working with them and maybe you don't have a huge list of investors, what I started with that every one of you can try is just do a quarterly newsletter, a physical newsletter. Write an article, include photos of Jake and Gino. Talk about your mentoring, talk about the events that you went to, talk about the podcast that you listen to, and send out a quarterly newsletter, because I wanted to just stay the top of mind reference for those people. When they thought of real estate, I wanted them to think of me. And a physical quarterly newsletter is what I started with years and years and years ago. And my friends would get it. They would take a picture of it and they would send it to me like, hey, I got your newsletter, man. That's really cool. It's great to see what you're up to. Many, many, many of those people have become investors with me now. The last step number 5, is you've got to follow a proven sales process. And so, I used to ham and egg it. I used to just wing it every time I was on the phone with an investor. And I would ask them different questions and it would go off on tangents. And I got really, really specific about the questions I wanted to ask them. And so when we do these big apartment deals, we register the stuff with the SEC. We typically do a 506B or a 506C Reg D securities exemption registration. And there's specific rules that you have to follow. And one of the rules is you've got to have a prior existing relationship with those investors if you're going to do a 506B federal securities exemption. So I can't just meet somebody and throw up on them about my offer. I can't offer them everything that we want them to invest in. We've got to build a relationship first. It's the requirement by the federal law. And so I've got a whole series of questions. It's 12 questions that we ask every single time, and we make it all about them. I even tell them, guys, I tell them, look, and this works great to diffuse any kind of pitchiness, diffuse any kind of salesmanship, and make the potential investor comfortable. I say, guys, look, the SEC requires that we have a prior existing relationship with you before you invest. So even if you wanted to give me $500,000 today, I can't take your money because we don't have a prior existing relationship. So what's cool about this is the exact language I use, by the way. What's cool about this is that we can just spend some time getting to know each other, today and maybe a week from now, a couple weeks from now, maybe a month from now. After we get to really know each other, then I can really talk turkey about some of our offers and some of the things that we're doing. But really for the next couple of meetings, I just want to know more about your goals, your objectives. What do you want to do with your money? What do you want it to accomplish? Are you accredited? Are you non-accredited? Are you risky? Are you not risky? So I have this series of questions that I ask, this proven sales process that's worked really well, because at the end, typically what's happening, guys, is these people are saying, well, we've been talking about me for the last week or 2 or 3 weeks every time I got on the phone. they're like foaming at the mouth to hear about an offer. Like,
Mm-hmm.
what can I invest in, Josh? Instead of the opposite, which is like hitting them over the head on day one with an offer. And then people are like, hey, let me think about it. I'll get back to you, right? I realized I didn't want that response. What the response that I wanted was, hey, I have this amazing apartment deal. And oh my God, Josh, can I please invest in your deal? Right? I wanted that type of reply, that type of response. And here's the thing, man, the slower I went, the better, deeper relationship I built, the more they invested with me and the more often they invested and the more they referred me. The faster I moved, the faster we talked turkey about a deal, the less they invested and the more skeptical they were, and I got less referrals. So that proven sales process has worked really good for us. And you know, we could go way deeper on this whole thing. I don't think we're gonna have time for all that today, but that process for us, that 5-step process has worked really well. So 1, craft an irresistible offer. 2, identify who your avatar is. 3, where can you meet your avatar? Where can you go, right? Step number 4 is create a multimedia marketing approach. Once you have cell phone numbers, you have email addresses, you've met people at events, how can you stay in touch with them in order to gain that appointment, gain that, you know, face-to-face meeting or that virtual meeting like we're having now on a GoToMeeting or a Skype call or a Zoom call. And then finally, step number 5 is follow a proven approach where you're really the advisor, quote unquote advisor. You're not a financial advisor, but you're taking the same tactic that advisors take, which is you ask tons of questions because you can't really recommend something unless you know what somebody's, you know, risk tolerance is and those kind of things. So the stuff I learned as a financial planner when I was 22 years old applies now in the real estate market of going slow, because I don't want to recommend something. If I want to serve people, if I want to take care of clients and help them achieve their financial goals, I'm not going to pitch them on my deal if it's not a fit.
Mm-hmm.
So it's all about them at the beginning.
I like that. Before we get to the short answers, last question, the long answer question. What would you tell an investor who wants to get into multifamily? What is your best recommendation to get into multifamily? If they're struggling, they're doing single family homes, they're on the grind, they want to get up to the multifamily level. What would you say to them?
Yeah. So first of all is you got to have some sort of mentoring. You've got to have some sort of mastermind, some sort of coaching. Whether, you know, it's connecting with you guys, Jake and Gino, your program's amazing, whether it's, you know, a local investor, but you've got to find a way to hitch your wagon to somebody that's ahead of you. So if you've never done a deal and you know a guy in your local market that's, you know, owns a 30 unit or a 50 unit, or maybe owns 200 doors and he owns a couple smaller properties, man, go talk to that guy. Go ask him, you know, go meet him at his properties, work for free at his properties, like do some maintenance for him, make his job easier, bring maybe some of your, you know, an investor that you might, maybe a passive investor that you might have, and maybe bring them to the deal. You know, do anything you can to associate with those people who are just, you know, a couple steps ahead of you. I would start with that. Secondly, you know, my friend Jack Petrick is a good example. You know, Jack was a single family investor, 50 rental doors, a bunch of single families, wanted to get into multifamily. He went to every event that he could. You know, that's a must do. Attend all the live events that you can. But Jack he didn't know any better, right? So I have a 164 unit with Jack, and it's an amazing story. Jack and he had a personal assistant. They got the list of all the brokers and all the owners basically in Ohio, and they hit the phones. They made 3,500 outbound phone calls to every broker, every owner. They just guerrilla sales tactics, made phone calls, introduced themselves, talked about how they had access to capital, which was basically me. We were partners, so they knew they could get the capital working with me. And he pounded the phones and said, look, I'm just going to call every owner, every broker, let them know we're in the market to buy properties. If they had a property, we wanted to look at it. If they knew somebody else that had a property, we wanted to look at it. And he just kept telling people, like, we have a goal to buy 500 units this year, 500 doors this year. You might have a 20 unit, a 30 unit, a small property, an 11 unit. I don't care what it is. We want to buy it. Do you have anything that you're thinking about selling? Right? And the other thing I would tell people is, look, posturing up with brokers is a big deal, but you can't posture up and do it and be fake about it, right? So if you're a newer operator or a newer investor that's maybe in resi, you're looking to go into multifamily, I would find guys like Jake and Gino, guys that have access to capital like we do, and try to like have that credibility kit that you guys talk about, get that going, posture up that you have partnerships with guys that are doing deals, and then go do the legwork, go do the work to connect with brokers, go to meetings and make those relationships. I mean, those are really the best ways to do it. There's other ways you can buy lists and do direct mail. Haven't seen as much success with that. There's been some for sure. But in this space, it seems to be very, very relationship driven.
Mm-hmm.
Let's take a quick time out to hear from our sponsor. Gino, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. I know that you've been hard at work helping Jake and Gino students do just that using our framework. Can you explain to the listeners how they can get our help?
Guys, we've been hard at work growing our community of like-minded investors, and the results of our members has been nothing short of incredible. We're looking to grow this amazing group. What we're looking for is those who want to follow our proprietary framework that we've created: buy right, manage right, and finance right. Leverage our connections, education, and mentorship as ways to take your business to the next level.
So if you're interested in finding out more about how you can become a part of our amazing community, apply to work with us at jakeandgino.com/apply. All right, and we are back. Yeah. A little technical difficulty there. Just want to hear a little bit about habits. I ask everybody this question: what is your best habit for success?
This is a relatively new habit, but it's my favorite thing that I'm doing right now. So I love the gym. I love to take care of myself, and I feel like if I had a friend of mine, Sean Stevenson, that was in a mastermind with me a couple years ago, and he told me something. He told our group something. He said, Josh, the cure for anxiety, the cure for depression, the cure for low self-esteem is self-care. Self-care. He said, you can overcome anything: abuse, depression, addiction, if you take care of yourself. And so I really think it starts with the habit of, for me, I have a couple things I do every morning. I get up before anybody else in my family, usually around 5:30 in the morning. I turn on the coffee pot and I go right to a gratitude journal. And I just throw up in my gratitude journal. I write about everything that I'm grateful for. It could be just waking up that morning, something my wife did, something my kids did, money that I raised, an investor. Because that sets the table for the rest of the day. I think the negative habit that I've experienced and I've seen so many people do is they sleep with their cell phone next to their bed. They wake up, roll over, and they go into all their social media platforms. And those social media platforms have all kind of messaging. And it could be a direct message. It could be an email. It could be a Facebook post. It could be a reply to a Facebook post, whatever that is. And all of a sudden now, if that's your habit, you're now very reactive to what other people are pushing at you. If you roll over and you jump into social media, you jump into your email, you now could have multiple different types of messages that are now going to control your attitude. They're going to control your mindset. They're going to control your day. So first of all, if you sleep, let's say you have wherever you sleep, I don't know, just leave your cell phone in a kitchen drawer, sleep with a regular alarm clock. So when you wake up, you don't have the ability to grab your phone, and then you can wake up, go downstairs. And for me, it's coffee, gratitude. Then after I'm done with that, and part of that gratitude journal also bleeds into posting and prioritizing the rest of my day and the rest of my week, because I'm already in the habit of writing for gratitude. I'm looking at what do I want to get done that day, that week. And then I hit the gym. If I can get in the gym and get back before my family really gets going, wakes up, my kids are on their way to school, or things are happening. If I've gotten coffee, gratitude journal, like kind of posted and prioritized my day and my week, and I'm at the gym and back, and all that's done by about 7, 8 in the morning, and now I'm started with my day, I almost always win that day. Now, there's definitely days I've had that are a total dumpster fire, right? Like we all have, that go wrong. But I can win most days by starting with that habit in the morning.
Nice. What about a book recommendation? Anything you read recently that made a positive impact on your life?
Yeah, Jake, thanks for asking. So Extreme Ownership by Jocko Willink is my favorite. I've been through that book, and then his second book, what's called The Dichotomy of Leadership, which is the follow-up book. I listened to all their YouTube videos, Jocko and his co-author, and I listened to him on Audible. I continue to listen to him. I've probably been through those books 4, 5, 6 times a piece. First of all, I've never been a soldier. I've never been a veteran, but I have a lot of respect for people that volunteer. And I don't know what it is about war and history. And that's just something I love to pay attention to, watch TV shows about that stuff. And so amazing books on his experience in Iraq, and then the leadership principles that he pulled out of that experience. So highly recommend those books and their audiobooks as well.
What is the best way for people to get a hold of you?
So just visit one of our websites. We just launched our latest book, which actually teaches a number of the strategies that we talked about today. And I'm actually giving the book away for free right now. Just pay the shipping. It's getflipsystem.com. Tells about my story and my fight of pancreatic cancer and a bunch of our strategies for raising capital and doing deals, both residential and commercial. So downloading and buying that book, we'll ship it out to them, just pay for shipping. That's a great way to get a hold of me and really learn more about my story. Always can connect with me on Facebook. And also my main website, which is strategicrealestatecoach.com. All of our background and bio and stuff is on that website.
Gino, take us home.
Mr. Stenziano. From a financial advisor sitting in a house that has a barn falling down, thinking is a hot shot, driving a sports car in a nice suit, to getting into real estate, to getting into the real estate. Because single family homes are great, but we all know that's a really hard business to start scaling up. And I like Josh's story. I mean, there's multiple ways to get into real estate. You want to buy your own stuff, that's great. You want to manage, that's great. You want a bird dog, that's great. You want to start raising money, that's great. You want to start partnering, that's great. There are so many ways, but I think ultimately what you need to do is you need to actually find somebody who's doing something that you like and success leaves clues, and follow them. And don't be afraid to invest in your education. I always say that all the time. It's never the right time. Like I say, it's never the right time to have a kid, right, Jake? It's never the right time to buy real estate. People always find excuses. It's the economy stinks, where there's no money to be raised. Now the cap rates are really low. Now the economy is going to explode. You need to start today and start creating those relationships and start creating those substantive relationships. So if you're going to start today and start buying, because and start using a proven method. We use buy right, manage right, finance right. Josh is raising money for his deals. He's got a specific avatar. He's got a specific criteria that he's looking for. Be successful at that, own that, but you have to learn all that before you get out there and become successful. And you don't need credibility, because none of us had credibility when we started. We started with the 25 unit. Josh started with his small single families, and he escalated, and he got into a really big deal in his first deal. So Stenziano, you want to add anything else to that? Because I could keep going on about Josh's story.
Keep it simple, short and sweet. Education times action equals results. Get on the podcast, give us a like, and appreciate everyone's time today.
Josh, thanks a lot for being on.
Josh.
Appreciate it.
You guys are awesome. Thanks for having me on.